Ladies and gentlemen, welcome to our first educational video. Today we're going to discuss what is cumulative volume delta, what is the CVD. So I'm going to explain what is the delta, what types of divergence we have, and also we're going to look at a few examples. Before I begin explaining all this, I want to begin with the following. You should understand that there are different indicators in the market. There are lagging, and also there are real-time data. CVD is real-time data, e.g. it's not waiting for any candle closes or anything like this. The data comes exactly at the time when a new contract is being bought or sold in the market. Okay, so this is the best indicator that there is in the market. This is the best thing that you can look for as an indicator. There is nothing better than this because the data is real time. It's coming at the same time. It's no lagging, nothing like this. So let me just get straight to the point. Let me explain first what is the delta. So, on the market you have limit orders, you have market orders. So what's the difference between both? So the limit order is a passive order, which actually you go into the market, you put up a limit order, and you're waiting for it to be filled. Your limit order can be filled only via market. There is no such thing as limit gets filled by limit. Everything gets filled by market orders. If everybody on the market played with limit orders, the price of any asset wouldn't move even with one tick. You should understand that. So you should be understanding that the market order is what is moving the price of any asset. So what is the delta? The delta is the net difference between buyers and sellers on market order. Okay, so you have, let's say in this candle, let's say you have 100 million buys on market and you have 40 million sales on market. So the net difference, e.g. the delta, is plus 60 million. Okay, in every candle you're gonna have delta, and also the CVD is calculated via the delta. Okay, so this is, let's say this is the daily candles. So this day you have plus 26, and eventually the CVD is like, because of the previous day, is like minus 36. So minus 36 plus 23 makes minus 13. Minus 13 minus 30 million makes minus 43. So this is how it's getting calculated, and eventually it's putting it as an oscillator. So let me just explain what is the CVD before I continue with the oscillators and the types of divergence. So the CVD is measuring the effectiveness of buyers and sellers eventually from the market orders. By looking into volume and delta, we can gain the understanding of how effective buyers and sellers are in the market and what are their actions. Okay, when aggressive participants are not effective, we form divergence, which shows the loss of momentum or a sign of weakness. We as traders, of course, we can profit from that. This is what we aim for. So the types of divergence that we have, the first one is about lack of participants. This is when price is moving up or down, but the CVD is not following the move. And due to lack of participants, the move can be viewed as a sign of weakness because they're being exhausted or weak. So this first type of divergence, lack of participants, at the top you have the price action, and at the bottom you have the CVD as an oscillator. So let's say price is making a higher high, but CVD is not following. CVD is making a lower low. So this means that the people that are moving the market, e.g. the market orders, they're not being effective. Same thing as if price is making a lower low, but CVD is making a higher low. This is showing you that there is no aggression towards price to move lower. So this is a reason price would actually start moving up, because there is lack of participants. And on the other side, you have the absorption, which is, in my opinion, it's much better and also much easier to understand. So this is when CVD is making a high or low, but price doesn't follow. E.g. aggressive participants are trying to move the market, but they're being absorbed by limit orders. So again, as I explained, the people with market orders, they're filling up the limits. So here, let's say on the first example, we have price action making a lower low, but CVD is making a higher high. This means that you have much more market orders here than here, and price is not following. E.g., somebody is, let's say, an entity or a market maker, you can call it whatever you want, is sitting here with limits and is absorbing all these market buys. Vice versa, on the other hand, you have price action making a higher low, but CVD is making a lower low. E.g., there are much more market sells at this area here, and somebody with limit is sitting here and it's just buying everything. So these are the two types that we have. Now let's look at a few examples. By the way, Discord link is in the description, make sure you join, it's free. So the first example, let's say the first one here, you have price making low, higher low, and the CVD is making low, lower low. E.g., somebody is sitting here with limit and just bought up this and price moves higher. And on the other hand, you have a bigger CVD that is building, e.g., from this low to this low, you can see low, low, another high low, lower low. But and somebody with limit orders is just sitting here and is buying everything. And this is the reason price just skyrockets. In the next example, this on a bit of a lower time frame, you can use the CVD on any time frame that you want, except let's say the daily or the weekly. I would stay away from that. And also I would like to see the CVD building up as here. This is a very nice CVD. In this example, this is on a very short period of time. This is I think it is a 5-minute time frame or the 15. Low, higher low, low, lower low. E.g., somebody sitting here with limits. I think this is like 30 ticks. One box is 30 ticks, and somebody is just buying this. And price moves higher. In this example, you have high, you have a lower high, and the CVD is making a higher high. E.g., somebody is sitting here with limits and is just selling a lot of limit orders here, while the people on market are just trying to move price higher, but they're not being able, they're being absorbed. And in this example, you have low, higher low, low, lower low. Same situation as the first example, you have the absorption type. So somebody is just buying with limit the market sells in this area. And he is being successful because price moves higher. Eventually, 9 out of 10 times the divergence is gonna play out. So be careful with first reading it, second understand it. In our Discord there's a free template which you can use. Make sure you join. It's for Azure charts, and you'll be able to use it and just go take a look and try to see a few examples of the CVD. Okay, this was the first video. We're gonna continue with the educational stuff. That was it for today. I wish you a nice day. Till next time. Bye bye.